Hello, everyone, and welcome back to another episode of the Market Outlook series with me, Kavita Agrawal, the founder of EXP Invest. Happy Diwali to everybody. And with Diwali, just like last year, we are also expecting the rally to come back to the markets. But let's look at things objectively and not just emotionally. And let's move towards the charts and see what are the indications on the charts of Nifty and other sectoral indices which strengthen our conviction. So let's get started. So on my screen now you're seeing the 3-minute time frame of Nifty. Let's assess what has unfolded this entire week. So from last Friday, where we connected the previous time, this entire week has been a lot of consolidation. Now, this consolidation is giving us a very important message, especially on the RSI. So on the RSI, you will notice that the 3-minute time frames RSI has been breaching above and sustaining above the level of 60 significantly lot more than it has in the previous week. This is called the bear range. This is called the bull range. Can you see the difference? If I zoom in a little bit more, you can see here when the momentum was very negative and strongly negative, the RSI was resisting the level of 60 and on the downside was breaching the level of 30 repeatedly. But now we can see that the RSI is sustaining above the level of 60 longer and barely coming down to touch the level of 30. So this is positive. Also, if you look at the activity on the very last working day, except for Muhurat trading, you will notice a nice little positive divergence here and back a shift back on the Muhurat trading day to the bullishness. I would not give a lot of attention to this because typically Muhurat trading people end up buying more than selling. So it's a anomaly. It's not really normal market activity, but overall this is what the indications are, that there is a positive divergence, there is a positive range shift. So 3-minute time frame is definitely looking than it has in many weeks over the last few working trading days. Right now on the 15-minute time frame, we saw there was a positive divergence back on the 7th of October, which did lead to some relief rally, but the RSI or Nifty price again created a double top somewhere around the level of 25,200 and continued the correction. Now, this green line is the 100 EMA of the daily time frame, which has been breached and has acted as resistance twice. 23,900 is a key support level, and we have also, we can say, tested the psychological level of 24,000 on Nifty. On the 15-minute time frame, a bull range is yet to be established. We can see the last correction that we witnessed on 25th October, which was last Friday, where a new low was forged in this correction. Over there, the level of 30 was breached, which is not indicating a lot of strength for the index. Also, the subsequent rallies that we saw, like I said, took resistance at the 100 EMA around the level of 24,500, which was the previous support, by the way. And also the RSI has been resisting the level of 60, which tells us that we are most likely still in a bear range, which means that for the purpose of accumulating positions, you still need to continue to exercise caution in the market. Now, we are very close to this important support level of 24,000. That is why I believe 24,000 to 23,900 is a pretty important support level that you should look out for in your trading activity. Practice very strong risk management at this point. Make calculated bets. Make sure that the risk reward ratio, wherever you're committing capital, is more than 3. Having these very basic controls can reduce impulsive trading, which is predominantly why a lot of traders lose money in a bearish market. So control your impulsive trading, have predetermined requirements for entering into a trade, and for the trades that you enter into, make sure you're using very stringent risk management tactics. Moving on to the 75-minute time frame. Now, I'm going to delete this positive divergence because clearly it was not confirmed. And the 75-minute time frame also continues to look a little bit bearish. So based on the 3-minute time frame, it looks like we might have a retest of the 25,500 level. But a proper resumption of a bull trend, maybe a little bit more time is left for that based on the observations being made on the 75-minute and the 15-minute time frames. Look at the volume activity here. What I can see is the volume activity was pretty strong when the price declined. So between this vertical line as well as I would say this vertical line, I can see very strong volumes, which was an indication that the downtrend is yet to continue. Now look at the second leg of rally, the second leg of decline, this one. Over here again, the volume has not been that strong, but it still has an upward tilt to it, right? Right now, since the price has been in consolidation, the volume has been pretty dry, I would say. It's not been low, it's not been high either. If you're wondering what kind of representation, this is the histogram representation of the volume, comparing the 20-day volume over the volume. Yeah, so 20 days over the 100 days volume. So this is the daily time frame. So this is 75 minutes. So the volume has actually been converted from daily to 75 by multiplying with a factor of. So 20-day is the fast length. So 20 into 5 is 100. The slow length is 100 days. 100 into 5 is 500. So that's the slow length for the 75-minute time frame. And I'm using a smoothing factor of 50. Now, on the 75-minute time frame RSI, I am noticing that the level of 30 was breached in the correction, which is indicative that weakness is still abound. The volume indicator is also suggesting a upward trend against decline in prices, which means that even though the selling is not as intense as it was, there is still support for the decline. 23,000, like I said, remains a very strong support for the market. And if this gets breached, then what? Then I believe we are looking at further correction to the next support. Where does the next support lie? I can see there is a high and some consolidation here around the level of 23,000. So let's update our markings. So this becomes our very next support. And we are also heading close to the EMA support of the 250 days, which is again a pretty significant level for the market. So I think this would be an appropriate next support. I'm going to round it off to 23,150. There we go. So these are the next three supports that we are looking out for in the market. As a short-term swing trader, it is very important to stick with strategy. The biggest mistakes that new swing traders make in the market is that they become long-term holders from short-term investors in the face of losses, which is the worst thing you can do. If you want to make that switch when you're accruing profits, not losses in your portfolio, because the most important, so there are two kinds of losses which you incur when you switch from being a short-term trader to a long-term investor in the face of loss. Number one, the absolute loss, which is erosion of capital. Second is the opportunity cost. If you had capital available and if you saw like a 4-5% opportunity, you could have taken advantage of that. But now you cannot because you don't have capital available. So that understanding is very important. And you can only implement that if you're mature enough about your swing trading and if you're logical enough about that. But if you're being emotional about accruing losses and booking small losses, then it's going to be very difficult to control your impulsiveness and your stickiness and your fickle-mindedness as well. So that's a 75-minute time frame analysis for you. Moving on to the daily time frame. Now on the daily time frame, last time we noted that the level of 40 was acting as a support, which was the bull range support zone. But the daily time frame is suggesting that support zone has been broken. What does that mean? What does that mean? That means we might see a little bit more correction. Now, on this daily time frame itself, what am I seeing? I'm seeing that last time we took a correction here. And when this correction happened, which was the October of 21, so this was a pretty major correction. This correction lasted about 260 days, 17% down, but with a lot of opportunities for you to reduce your exposure to the market, exit, reallocate your funds, probably even recover some losses if you had good counters holding, if you had strong risk management. Versus if you look at this correction has not really given us exit opportunities. So only traders who have managed strong risk management are going to see survivability. This also poses the threat that this might just be the first leg of the correction when we might see a temporary bounce back and continuation. So there was a negative divergence on the daily time, which was an indication that we might be heading for a bigger correction. And now we're seeing the support level, the previous support level of around 45 also getting broken. So the daily time frame again is definitely not looking very promising. I think as long as we continue to sustain below the level of 24,500, 24,600, more correction should be expected in the market. With that, let's move on to other indices. As usual, we'll start off with Bank Nifty. I can see in Bank Nifty 75-minute time frame, there was a positive divergence, and we have seen a nice little leg of upside with which has taken the market or Bank Nifty to the resistance of 52,200. And the good thing is that this upside has been seen with pretty strong volume. So I think the banks are looking pretty strong from a short term perspective, at least, right? Because even on the daily time frame, at the end of the day, there is a negative divergence. Short term swing trade bets in the private bank sector is not a very bad idea. But again, I will insist, maintain strong stop losses. 2% rally can be expected, and a 2% rally in private banking index does translate to a good 5 to 8% rally in individual stocks if they pick up on that tailwind. Next, let's look at the PSU Bank. I am not feeling very positive about the PSU Bank, not as positive as the private sector banks, because there is the 100 EMA posing as the resistance. There was a small positive divergence, but the PSU Bank has also been struggling from this negative range shift. So this might actually be an intermittent rally, and the continuation, the decline might actually continue here, is what I am seeing. So not very bullish on public sector banks as of yet. What about pharma? So pharma, I'm seeing a massive negative divergence got forged on the daily time frame. And last to last week, I told you to exercise caution. Pharma is not looking very attractive for making fresh positions. I do see on the 75-minute time frame a little bit of momentum reversal in the form of a positive divergence, which could be an indication for us that a short-term rally might unfold. And I think pharma stocks in the last week have given pretty good moves. So those moves might continue for another week or two. Not, I don't expect it beyond that. Again, healthcare, same outlook. Positive divergence is definitely there on the 75-minute time frame, which can take the RSI back to the level of 60, 65, which means a small rally or probably a retest of the previous high may be witnessed. A 3 to 6%, a 3 to 4% rally on the index itself can translate to 3x of that rally in the stocks. So short-term opportunities in pharma and healthcare may be paid attention to. FMCG, I can see the FMCG has declined quite a bit, almost 50% correction of the previous rally has been achieved. And if no further correction comes in, then we can expect some rally. The 15-minute time frame is indicating short-term strength here by indulging in a positive range shift. You can see it taking support at the level of 40. So your risk reward ratio is actually quite attractive here in the FMCG sector. So if you keep this as a stop loss here, around 58,200, then I think this previous high over here, even this one actually, can be looked at as a potential target zone. So we are expecting a 5 to 6% rally in the FMCG sector most likely, which would again translate to around, say, 10 to 12% in individual stocks. But again, FMCG is a pretty defensive sector. It makes sense that it's looking bullish because the market sentiment is quite bearish right now. Defensive sectors tend to look stronger. What about infra? So I am not feeling very convinced about infra because I can see a little bit of a strong negative divergence, and also the breach of the level of 40 is not making me very comfortable. The 15-minute time frame is also not looking very strong right now, I would suggest. I think a little bit of rally that has already come is pulled back. I wouldn't expect it to continue, might see some consolidation here. So I think infra and realty both, I am not very interested in making active positions in because there is no strong, active, bullish momentum there. What about the energy sector? I'm seeing, so I was actually assessing some stocks in the energy sector, and I could see some opportunities building up there. So I think it is trying to create a base, and it can give opportunities for short term swing trading in the next 2 to 4 weeks. So energy sector is definitely on my radar. What about finance sector? The finance sector is actually looking a little bit better than both the banking, private bank and the public banking sector. And I have in fact picked up some stocks for the long term in the finance sector, and I've also issued recommendations in my long term plan. So if you want to build a long term portfolio with stocks which are fundamentally strong and technically at the right time, cyclical lows, giving good technical indications that they can rally, then my long term plan is definitely something you should check out. I'm going to drop the link in the comments for you right now. So here on the 15-minute time frame, I can see a very subtle shift to the bull range happening. So even though there is a lot of volatility in the finance sector, I think if you keep a slightly bigger outlook, 3 to 6 months maybe, some opportunities are definitely ripening in the CNX finance sector. The media sector is volatile as ever, but it has definitely bounced back from this support, and it can be expected to show a little bit of rally. But honestly, given the broad volatility in the market, I'm not very interested in dealing with a sector like media right now. I would rather go for slightly safer sectors. Metal sector is actually also being very volatile. Over here, I can see there was a huge range shift, negative divergence and range shift, and since then it's been in a correctionary mode. So until and unless the metal sector doesn't sustain above the 20 EMA of the daily time frame, I think I am going to refrain from touching the metal sector for now. Consumption sector has actually started to look really attractive. If you remember last time when we assessed the consumption sector, I'd asked you to wait for it to come down below the 100 EMA to look for opportunities, and it has actually done that. So I think the underlying momentum in the consumption sector continues to remain pretty strong. And right now, it has given a pretty big correction, shown some consolidation. 75-minute time frame is also giving a positive divergence, and I think it might just be ready to start rallying. And consumption sector is actually one of the more reliable sectors, especially when you enter it at the right time. So I am definitely keeping my eyes out for potential opportunities in the consumption sector for the months and weeks to come. Same goes for the service sector. I think the service sector underlying rally has been pretty strong. The daily time frame is suggesting a strong bull range. 75-minute time frame is suggesting that the intermittent correction might actually be over because the momentum here has started to show positive divergence. So service sector is also looking pretty strong to me. So that is also where I will be looking for opportunities. What about the auto sector? So auto sector has actually taken quite a bit of a hit. And if you remember, a few weeks back in the Market Outlook series itself, I had noted that there was a negative divergence and had warned against continued participation in the auto sector. Now I think a significant chunk of the correction has come to an end, and an intermittent rally might unfold, but you have to be careful because this might just be that an intermittent rally and not a full-blown rally. Because on the 75-minute time frame, what I am seeing is a sort of a shift. So right now, if you look at this entire section, this has been a bit of a mixed bag. So clear-cut bullishness ended around here, and since then it's been like a little bullish, it's been a little bearish, again it's been a little bullish, it's been a little bearish. So usually this kind of activity happens when a big trend is coming to an end. And if you look at the daily time frame, you can clearly see that the auto sector has been in a pretty strong rally. I want to especially caution you because retail traders have a tendency of getting stuck in these long-term upward trending sectors right at the top. So this pullback is actually what retail traders who don't adhere to sophisticated analysis methodologies, they might see this pullback as an opportunity to participate in this rally, but you might just be entering in the wrong side of the trend. And I would strongly recommend that you exercise caution, because if you look at the previous rally also, if you saw this as a potential pullback, You might get a little bit of a rally, but then again, you'll get stuck on the wrong side of the trend, which is not what you want to do. And since this is a pretty big uptrend that has already folded, the subsequent correction might be deeper and long lasting. So you don't want to expose yourself to that. Commodity sector is not looking very attractive. The PSE sector, I've been warning you guys against making positions since months now, and I will continue to issue that warning. Not very attractive sector. I think IT sector is undergoing an intermittent correction, but I think the underlying trend continues to remain pretty strong. But in the short term, over the next 2 to 3 weeks, we can expect more correction in the IT sector. So I actually had a long-term recommendation in one of the IT stocks where I have asked my clients to book profits. So we booked around 65% profits in a matter of 6 months instead of holding it for a whole year. Whew. With that, we come to the end of today's Market Outlook series. Thank you so much for joining me for the session today. I will see you again in the Let's Get Technical series where I will assess your stock analysis requests. So if you have stocks that you're holding that you'd like me to comment on, tell you whether it's a good idea to add more, hold, exit, or stop loss and target, or if you're planning to make fresh entries, better to take an analyst's opinion before you really go forward with that. All you have to do is head over to the link above my head, submit your request, make sure you go through with the payment. There's a very nominal charge just to maintain kind of quality control on the requests that I'm getting. There's a very small nominal charge there. So make sure that you process that, because without that, your request will not qualify, will not come in front of me. So with that, I'll take a leave. If you've learned something new, if you've enjoyed the content, if you found it useful, don't forget to leave a kind comment. It really makes my day to read your comment, and definitely give a thumbs up to this video. Thank you so much for joining me. I will see you again next week on Wednesday at 5 p.m. So thank you so much.